Good morning and welcome to the Killik podcast for Friday the 13th of February. It's been a week of politics with the Ukrainian ceasefire early in the week being an incremental positive to markets, but the market's really been blown around by the Greek negotiations with the ECB. As you can see here, we've got the DAX and the Greek index, and it's correlated very closely this week. The market still expects some sort of compromise, and the next meeting will be on Monday, so we'll be watching that closely. We've also had quite a big uptick in Treasury yields. So here we can see the 10-year over the last 15 years, and as you can see, it's at very low levels historically, but it started to come off that low level that we saw early in the year, and that's quite interesting for us in terms of bank shares. So we've been talking about this a bit. Bank shares tend to follow higher yields higher. So here we've got Barclays. And then Wells Fargo in the States. And as you can see, that's mapped against the 10-year gilt and the 10-year Treasury. And you can see that the appreciation in those yields does flow through to those stock prices. Just going back to 2013, when the US Treasury yield went from 1.6 to 3%, it's quite a big move back in 13. We can see that the Wells Fargo price tracked higher and increased by about 30%. So that's an interesting idea if you do feel that central banks in developed markets are going to get more hawkish. Those two stocks are on our best ideas list. We've unveiled this list for the first time this week, as you can see there. There are a number of ideas here, of which a new initiation was on Michael Kors. Michael Kors is a affordable luxury company. They make handbags and accessories. Principal markets are the US, but they are sort of expanding more globally. This stock is a value play in what is traditionally quite an expensive sector. So Michael Kors used to trade on around 26 times earnings just around 18 months ago. But since then, we've had concern over the direction of the margin and the sustainability of their luxury brand and their pricing power. So now it's trading at quite a big discount to their comparatives, which the sector's on 18 times, they're on 15 times. We feel that is wrong, and it's pricing in a real decrease in profits that we don't see coming through. So their last quarter, they came out with a 30% sales growth, and their gross margin was stable at a very healthy 60%. So I think that's an excellent time to be buying this story. Also this week we had the Premier League rights, which is interesting both from our view that content is getting far more valuable, but also how it impacts the distributors of those pieces of content. So here we've got BT, which is on our buy list, and we initiated a couple of weeks ago, which we feel is in a very strong position in this marketplace. And we saw, following the rights, that Sky, who take 50% of their customers take football, so it's extremely important for their subscribers, paid up for retaining their Premier League position, and they paid 83% more for those rights than they did 3 years ago. BT only paid 30% more, and therefore we expect EPS consensus for BT to increase on the back of that, and we expect some sort of downgrade coming through to Sky. So we're seeing a sort of further shift in our view in terms of that particular story. And here you can see the performance of both Sky and BT since that result came out early in the week. So the market sort of going with BT on the back of that. I've also showed you Manchester United, which obviously a more direct beneficiary of that higher rights number, which has been strong on the back of those, and it's starting to become quite an interesting story on the top line if they can control their cost of debt and the appreciation of players' wages. So just looking at a longer term, this is the last rights negotiation back in 2012. As you can see, the BT share price has been far stronger as markets have started to bet on further market share gains, BT eating into Sky's subscriber base in terms of pay TV. So the week ahead, we've got Intercontinental Hotels on Tuesday of the Killik & Co stocks, and Solar City on Wednesday. So those are the main things we'll be looking out for. On Intercontinental Hotels, we expect quite a positive update. We've seen, we feel we'll see an acceleration in earnings in the US as we see that cyclical upturn coming through. We've also got a potential buyback on their Spanish hotel, which is about $1.5 billion, and potentially putting their Hong Kong hotel up for sale. As you can see, the share price has been a strong performer, and that's on the basis that it's got a very attractive business model. So 95% of their revenues come from franchises. So they've been selling hotels and then franchising the management of those hotels off the buyers. So it's a very high margin, low capex model. The shares currently are good value. They trade around 20% discount to the US peers and will benefit from a cyclical upswing in the US and Europe. And the hotel market in both of these geographies is attractive because there's not a lot of supply of hotel rooms out there at the moment. Additional attractiveness of this stock is that they plan to return more capital to shareholders. And as you can see, since 2004, they've returned about 52% of their market cap in terms of special dividends and dividends. Through that, they've reduced the share count, i.e. the shares in issue, by around 62%. So that really drives earnings per share because earnings are on a lower number, and that's really driven this share price appreciation. So that's it from me. Have a good weekend. Thanks very much.